Welcome to Machine Minds, where technology and humanity meet. I'm your host, Greg Tarusian, founder of Samson Rose, a recruiting and search business focused on the robotics and AI industries. The Machine Minds show is where we dive deep into the intricate world of robotics and artificial intelligence. As a staffing industry leader with a passion for the frontiers of technology, I'm pleased to be bringing you intimate conversations with the founders, investors, and trailblazers who are at the heart of the AI and robotics revolution. In each episode, we dig into their journeys, the applications of the products they're working on, and the breakthroughs that are shaping our future. Join us as we explore how these machine minds are transforming the way we live, work, and understand our world. Whether you're an entrepreneur, a tech enthusiast, or just curious about this amazing field, you'll learn something new with each episode. Let's delve into the extraordinary. Let's delve into machine minds. Hello and welcome to Machine Minds. I'm your host, Greg Tarusian, founder of Samson Rose, your robotics talent search partner. And on today's episode, I'm joined by Manas, Senior Associate at Woven Capital. Thanks for being on the show today, Manas.
Thank you. Thanks for having me. Looking forward to this.
Yeah, it's my pleasure. Let's jump into it. So want to welcome you again to the show. And usually I like to kick off with finding out more about our guests. So I want to find out a bit about your personal journey, what drew you to the world of investing, and what were the key turning points that led you actually to Woven Capital in your current role?
Yeah, I actually began my career trying to be a founder, not in anything to do with industrial tech or machines or robotics. It was in the education space, but it was I was really passionate about it. This is when Coursera was coming up, and as students, we had started using Coursera, and I was like, well, why can't we use this for vocational training with blue-collar workers? And we raised a little bit of funding. Unfortunately, it didn't go very well. And so I stood at this crossroads, not really knowing what I wanted to do. And I did what every young person who doesn't know what they want to do does. I went into consulting and then investment banking. Which was a great experience, and I think taught me a lot of the stuff that I do now, which is how do you analyze a market, how do you evaluate a company or an investment. But I was itching to work with startups, and then that led me back to a venture fund that focused on investing in education. It was called Owl Ventures, and then after that, I went off and used some of more of my financial toolkit and skill set to work at Andreessen for a couple of years, and then joined Woven Capital a little over a year ago. Really to in some ways to complete the circle, because I focus a lot on, serving customers in and around the industrial sector, contracting, construction, manufacturing, with my first startup. And I've now kind of made this journey back to focusing on investing in industrial tech. So yeah.
Very cool. So obviously your background, it spans various, verticals, strategy, M&A, startups, venture, etc. How has each of those shaped the lens that you actually look at and evaluate companies at today?
Yeah, I think the most important thing when we are trying to evaluate companies are usually the companies we're trying to evaluate are showing early proof points. We invest at the growth stage. So investing in typically companies that are doing a few million in revenue. They've got their first few customers. They've started figuring out their go-to-market. And there's early proof points that have emerged that this technology is valuable and customers are willing to pay for it, and that they see it ROIing it. What we're then trying to do is trying to understand what will it take for this company to scale to tens of millions of hundreds of millions of revenue. And when it begins to do that, what kind of exit can we get? So actually having a good understanding of public markets and M&A is really important, because it allows us to think about where's this company headed over the next 5 to 10 years. And if all that becomes true, what kind of exit can we target? And therefore, what are we willing to pay today in terms of valuation? And so actually, it's really helpful to do that. And also, I think because of our background, it's helpful to then work alongside these founders as they're trying to figure out other forms of capital, right? Because I think that this early stage venture and growth stage venture are two different asset classes, they're two different return profiles, and they're trying to solve for different things. And a lot of times, the things that work in early stage venture for a founder in terms of fundraising, in terms of storytelling, may not at the growth stage. So actually having that public market background, the M&A background, is really helpful because we are able to then give actionable advice to our founders who are then thinking about downstream capital or thinking about, oh, how do I think about, potentially considering an M&A discussion, et cetera, et cetera.
Interesting. Yeah, that's super valuable, I think, especially for those stages, because that's such a crucial point. We're seeing obviously less and less Series B, C, D round fundings, but then also less that are successful past that stage, right? So to have partners that have been there, been in the trenches, know what late stage capital exits look like, I think that's valuable for the founders and the companies in general. Before we go deeper, just for our listeners who are unfamiliar with Woven Capital and like your association with Toyota, etc., how are you guys positioned within the broader ecosystem? Who are you guys basically?
Yeah, so we're an $800 million fund backed by Toyota. We typically write $10 to $50 million checks in directional areas which we think would be relevant to Toyota. So I'll give you an example. We are investing in areas where we think Toyota will be either wanting to be a player in the future or in technologies which Toyota can hopefully leverage in the next 2 to 3 years to enhance its capabilities, drive revenue enhancement, or improve costs or the cost structure. So that's how we think about investing. Toyota has a few different funds. You may have come across a sister fund of ours called Toyota Ventures. They focus on a little bit earlier stage. There's some other funds like that Toyota has backed, like the Sparks Mirai Fund, which focuses on a different stage. Think of us really as a growth stage partner for startups that are looking to play in areas around industrial tech, around mobility, areas which Toyota is a massive player. Because if you think about, everyone knows the manufacturing side of the business, and that makes a lot of sense in the automotive side of the business. But Toyota also does one of the leading material handling companies in the world, one of the leading forklift manufacturers in the world. So there's a lot more going around in that group that we can add value by making introductions for the startups that we're investing into.
Awesome. And what kind of startups get you excited?
I think right now, the potential of robotics and automation and what people are calling physical AI or embodied AI in the factories is hugely, or in the warehouses, is hugely exciting to me personally. We've reached a point where if you think about traditional robots that have been deployed in these areas, think like an ABB, there's a car, there's a defined task. You have to go and you basically program this end effector, this welding end effector, to go and do the same task 100,000 times a day. The job is very well defined. I think we've reached a point where we are beginning to see early signs that robots are able to take a slightly unstructured problem and be able to address those. And that just really widens the aperture of what is possible. And that is really exciting for us. I think there's a lot of value to be generated. Robotics traditionally has been the sure shot way of burning money. But I think we've reached an inflection point where we're beginning to see very good, strong ROI and unit economics, where customers are willing to adopt new monetization methods like robotics as a service, RaaS, which I think gives this sector a lot of potential in the next 5 years.
Definitely. Yeah. I think hardware in general has been a slippery slope for a lot of investors historically, right? Burning money or uneducated investors in terms of like the timelines or the amount of capital that's required. And then it's been like that bump of heads of the tech isn't ready for what needs to be done, or the cost of hardware has been too high for where they need to be for unit economics. And now, like you said, we're at that inflection point and people are really starting to see the ROI, see the use cases, and whether it's been catapulted by COVID or people just not wanting to go back into workplace or the lack of talent in certain areas. Super interesting time across the board.
100%.
How does being backed by a corporate like Toyota impact the way that you invest or support your portfolio companies? Obviously, you guys are looking at things where Toyota can play in the future, but
I would say in two ways. I think one is getting I'm the last person who's a subject matter expert. I know how to evaluate a market. I know how to evaluate customers. I can evaluate unit economics, but to be like, hey, this works on the factory floor, that is really difficult. And having a network of thousands of engineers who work on these topics every day, like at a plant, as a control engineer, as a manufacturing engineer, as some people who've implemented robotics at large scale in plants, in manufacturing, in assembly lines. That is really the secret sauce. We're able to essentially tap on to the expertise of this massive network of engineers and PhDs who have real world experience essentially buying the products that these startups are selling into, and get their view on like, hey, is this something that you can imagine adopting in the hundreds and thousands? I'll give you an example. Humanoids. A lot of excitement about humanoids, right? But when we started looking at humanoids, we went to people in the factory and we were like, hey, is there a path to adopting hundreds of these in the next 2 years? And got real time feedback on what will it take for that adoption curve to really take off. And so getting those real world insights is really valuable for us to inform our diligence decisions. The second, I think how we try to add value to companies that we end up investing in, or even companies that we end up coming across but decide not to invest in, is making those introductions into Toyota. Toyota is a massive organization, does tens of billions in revenue every year. There are thousands of people across geographies, different decision-making nodes. It's a organization that may be a little bit daunting to navigate from the outside. So we have a portfolio success team, which I think is really, the powerhouse of our organization, is that portfolio success team. And they work alongside these companies and the investment team in figuring out what parts of Toyota could be potential customers. So after we invest, we organize introductions, but also forums for these companies to be able to get to know different parts of Toyota. This includes we took a bunch of our portfolio companies to Japan last year for them to be able to be introduced to different parts of Toyota in Japan that may not come across these startups, which are mostly in the US and Europe. This year, we're partnering with a few other VC firms to take another set of our portfolio companies to Tokyo and expose them to 100 Japanese corporates. Japan is the fourth largest economy in the world. There's a lot of potential, especially if you're building in areas around industrial tech, machinery, etc., hardware. There's a large untapped market potential there. And breaking in can seem daunting, but once you go out there and you see the potential, you can then understand, hey, is it worth me putting in dollars, setting up an office, hiring a BD person? Do I see that early motion? And we're trying to make that entry in a sandbox environment, which is easy for these companies to do, because we're willing to handhold them and bring them over and be like, hey, was this worth it? Do you see ROI here?
That's awesome. Yeah, I mean, speaking to clients, like my own client portfolio of clients, when they look at Asia, it's especially Japan specifically, like culturally, it's so different to the US. And if you don't have boots on the ground, if you don't have people that are local or understand the culture, even from a hiring perspective, as something as simple, you're like, it's a broken process and it's an uphill battle. So having the support, having people that know the space, know the companies, know the language, know the culture is super important. Are there particular geographies or ecosystems that you're closely watching right now, or that you guys focus on investing globally?
Yeah, so we are a global investor. I would say about half our portfolio is in the US, a quarter is in Europe, and a quarter is in Asia. So we want to invest. The best founders, our belief is the best founders come out of not just SF or New York, they come out of the world. And so we are scouring the world to find the best companies. It doesn't matter where you are. We've got a portfolio company in Norway. We've got a portfolio company in Japan. We've got portfolio companies here in the Valley, in LA. So regardless of where you are, we want to invest in you because we believe that the best founders can come from anywhere.
And when you're evaluating growth stage robotics, AI, automation, any companies that all the areas that you guys invest in, what makes a founder or a pitch stand out to you?
So I think it's two things. I think one is a deep understanding of the sector you're selling into. We're typically investing in companies, as I said, the growth states, they've typically got a few million in revenue. They've already got a few logos that they're selling into. And so really understanding the go-to-market motion, sales motion, the scale-up motion of like, how do I take this business from, I don't know, 5-6 million in revenue to 50, 60 million, 100 million in revenue? What's the path to getting there? What do I need to do? What have I done so far that has worked? What hasn't worked? And what do I need to change? Right? I think someone who's like very self-aware of, the gaps, the questions that need to be answered, the things that still need to be unlocked, just like a very like introspective person who has already proven that they know how to get traction. They've proven the tech works. They've proven there's ROI, but they've also learned lessons from that journey on like, what will it take? This is what got me here. What will it take to get here? I think that is something that I think is a very keen differentiating insight. When you have founders who come to you, who tell you, hey, I've built a $6 million annual revenue business, and this is everything I've done wrong. And this is what I plan to fix with the next round of funding, right? That is, I think, a really powerful message. Because it's very, I think, because it shows to us what will be needed to get to 60, 100 million revenue. Because we're trying to back companies that are maybe today, early signs of growth, early signs of traction, but then are at the position that they can then take off and reach an inflection point. So I think that is one. I think the second one is just seeing what will this funding do for you. In some cases, we're investing in companies. Like, I'll give you an example. I won't take a name because we haven't announced it yet. But the company is doing we did 40 million in revenue last year. Is on track to do 100 or so this year. And I think what we're trying to understand is, from them, is not necessarily about growth, because the growth is pretty baked into how things are progressing, but what will it take to go break even? Like, how do you hit profitability? So having an idea about like, oh, this is what my economics look like today. And at this point in the future, having just an idea of like, what will it take to be able to be cash flow positive is really important. Because I think the biggest problem in hardware becomes that valley to cash flow positivity is really long, the J curve. And the J curve also has a susceptibility to be extended. So cost overruns, delays happen. And we, as investors, anyone who invests in hardware is aware of that. But we want to, I think, ideally hear just candid, honest perspectives on what will it take to get there. And if we miss, what can we do to try as investors be helpful?
Yeah. I love that. Yeah, I really loved like what you said there about self-awareness, because I harp on that point a lot, regardless of stage. It could be like pre-seed stage, sole CEO founder. If they aren't self-aware of their limitation of what's needed, okay with relinquishing control or bringing in experts, taking advice from outside, that's just going to feed into the later stages. And at this growth stage, which I think a lot of companies fall down at that stage, why they don't get the funding, why they don't go past that mark, is because they aren't aware, or they think they know different or better, or they haven't brought in the right people. I mean, I'm obviously looking at it from a talent perspective, but you might not be an expert on cash flow, on sales, on your finances. But if you haven't brought in an expert to help you and taken their input as a founder, as a leader, and digested it and looked at and analyzed it to think about your next growth push, it's a broken process, right? You're missing such a huge part, and then that stops you from raising that capital, and people like yourself hesitant to invest. So great advice. With that in mind, I wanted to ask about how you weigh deep tech potential versus near-term commercial viability. And it sounds like I've had this conversation a bit recently about, moonshot ideas. Like, you're not seeing many of them around, and obviously they are a money drain for the short, maybe not even the short term. Like, it could be even for 10 years, right? You really have to have committed investors with deep pockets to keep pumping money into something where there's no market, where you're creating new technology, where you're creating customers, where adoption, all of that stuff. Do you guys operate or play in that space?
Yeah, No, definitely. I think we want to back the most brave founders. So I'll give you an example. We invest in a company called Stoke Space. It's trying to build reusable rockets. Uh, a colleague of mine called Jarek led that deal for us. And that company, I think, has identified what really convinced us about investing in it was, yes, we know the first launch is, still a while out when we invested. We invested a while ago. They haven't done their first launch yet. But what they were able to show to us or demonstrate was key unlocks that they had done and how they had a history of being able to, they had these key tech unlocks that they had previously done, and they hit them all either on target or before target or on budget or before budget. So, so demonstrating to us that you have a pattern of doing that. And after we've invested, we've seen that same trajectory continue. And so, yes, I think, space rocket launching is a moonshot. It's truly a moonshot idea. But I think the opportunity there is really large. And if you're able to find teams that are disciplined and that have that ability to like demonstrate, like, what will it take to get to the next stage? And a lot of times in hardware, sometimes you're investing in companies that are not going to, like for instance, in space or even in defense, that may not have, the next stage may not be that, hey, the company will jump, unlike software, will jump from 10 million to 30 million in revenue. It may be a tech unlock that needs to happen, but you need to tell that to your investors beforehand as you're fundraising. Be like, hey, this is what I'm fundraising for. And in order to fundraise the next round, this is what I'll have to achieve. And these are the intermediate steps. And each of these unlocks will happen. And I did the same thing for my previous round. When I went out and raised my seed, I was like, in order to raise my series A, I'll have to do X, Y, Z. And I was able to achieve all of that. So I think it's fine if the unlocks are not necessarily commercial. We understand that in hardware, sometimes the unlocks are technology or technical. But just being able to demonstrate that you're able to get there and what those unlocks will be, that would be really helpful. Actually seeing those unlocks. And we're investors in a company that we announced called Tacta. And what I will say is that the team had an amazing, very thorough plan around what were the key unlocks in the next 3, 6, 9 months. And they constantly, as investors, update us on what those unlocks are, because we now have a very good idea of what will this business need to look like 2 years after we invest in order to be able to fundraise the next round.
That is great. I love that. And I think for a lot of the founders, first-time founders, hearing that, not reassuring, but probably like peace of mind that what you're hearing from some investors that is just all about unit economics or revenue and stuff like that can be repositioned with technical milestones, technical unlocks, and just achieving what you set out to achieve in those stages and communicating that's what your funding is for. Because more and more when you go to some of these round tables and events, it's all just about revenue and route to profitability and stuff like that. And I think it's pretty short-sighted for big projects, for moonshots, for new tech, especially in hardware. So that's really helpful. Any common mistakes or red flags that you see from growth stage founders making when fundraising?
I think sometimes I think maybe being too optimistic. And I think, let's say that there's a business that has been flat for the last 2 years, and then, showing that hockey stick, hey, next year we're going to 5x revenue. I think over time, what you're trying to build is a relationship. None of us are investing in companies because it's not a stock. I'm going to enter in Jan and get out in December. We're all making multi-year bets out here. And so what we're trying to do is form a relationship with someone that we can converse with and have a realistic conversation on what is possible, what is not possible, and accordingly figure out what is plan A, what is plan B, what is plan C. So I think just seeing that kind of level of humility and candidness and candor is I think something that's can really differentiate a founder.
You've looked at deals across multiple sectors, obviously. What themes or subsectors are becoming especially compelling right now? You obviously mentioned embodied AI and stuff like that, but what else are you seeing?
I'm going to give you a different example because I think everyone knows about the opportunity in robotics. I think a lot of people have talked about it. I think there are so-called unsexy industries that have huge potential in being able to raise venture-backed funding today. I'll give you an example. Dealerships, traditionally, that only some categories there have been able to raise venture funding. Techion's a great example, right? Trying to build a DMS, you're trying to go after Cox and Reynolds and Reynolds. There's a large business to be built in dealerships. But if you were trying to build some kind of point solution for dealerships, I don't know, 4 or 5 years ago, it would have been really hard for you to raise venture funding because the market just wasn't that large enough for these people to go and spend on software. Now with the rise of agents that we're seeing, you're seeing new companies emerge like a Toma or a Numa that are essentially going after, I can solve pain points that today, you have 10 people working on paperwork or you have 10, 15 people doing a repetitive task. Can an agent come in and help alleviate that and help drive efficiency? And so now people are willing to pay for outcomes and not just for seats. So earlier it was like, hey, I'll pay $100 per seat or $1,000 per seat or $5,000 per seat. And now people are saying, I'm willing to pay for outcomes. And I think that is hugely powerful. And I think those are the kind of opportunities that we see. Like industries that were earlier considered too small to have venture-backed outcomes. $1 billion plus outcomes, $2 billion, $5 billion plus outcomes. But now we see a path to it because the rise of agents, the rise of AI has enabled you to go after workflows that earlier you could not have just solved by launching a SaaS or a software solution.
Yeah, that's really interesting. Hadn't thought about that. Are there any areas within automation or mobility that you feel are overhyped or misunderstood?
I think in general, I think there's a lot of interest in defense today, in defense tech. And I think some of that is justified, but I think everyone looks at Anduril and thinks that I will be the next Anduril. And so I think some of the valuations, I think getting in on those deals, and there's a lot of people who were not, when we've been around for a few years now, and there have been new funds that have coming into industrial tech that we just did not see, 2 years ago, for instance. And that is driving up, obviously, valuations. It's driving up around competitiveness, which I think helps the sector as a whole. But sometimes it's just, it sometimes feels like, are we in a hype cycle? I think there's a lot of potential there, but we just need to be able to figure out what works and what doesn't. And I think there'll be some expensive lessons that we'll all learn along this way.
Yeah. Yeah, I think that stuff helps a sector in the short term. But then we've seen a lot of down rounds and stuff like that from sectors that were hyped previously, and there was a lot of competitiveness and overfunding. And we're going to see that with AI, I'm pretty sure, in the coming years as well. So it's great for the ones that succeed and are able to do the good stuff with the capital and with the partnerships and all of that. But for the masses, I want to say it's probably going to be a bad thing. So you got to get the right bet. Looking at your portfolio and the impact, I want to touch on that a little bit without naming names if it's confidential. Can you share a story or two of companies in your portfolio that really represent what Woven Capital is all about?
Yeah, there's a few. I'll give you an example. We have a company in the space category. And when we invested in them, one of the things we did was we made an introduction to Toyota. Not really knowing where that would go, but we have a portfolio success team and their role really is to try and drive collaboration between the portfolio and Toyota. Now, what we learned from that process was that a few months later, Toyota and that company went out and they bid for a JAXA project, which is JAXA is similar to NASA, but in Japan. And they won that project, right?
Oh, wow.
And so
they went for it together?
They went for it together. And this portfolio's technology was key, one of the key components of that contract that Toyota went and won with JAXA. And that's one of the success stories that we have around our portfolio success team working alongside the portfolio to drive collaboration and interaction that did not exist before we were investors. And having tangible near-term positive impact in I think under 12 months or under 18 months. Another example is a company that is in the EV charging software space. And we did a lot of work, not with Toyota, but we did a lot of advocacy work with other automotive OEMs in trying to be like, hey, this is amazing technology that you should think about adopting. And so that halo effect of having that Toyota logo helped them unlock new customer relationships in that category, because there are other automotive OEMs that often look at like, oh, if Toyota's adopting this, maybe it's something worth spending time on. I think those are some of the stories of how we can add value to our portfolio and how we've tried to be not just capital providers, but value-add investors on the cap table.
That's great. Yeah. Having something like that just catapults the company, but also proves that you guys are value-add investors as well in short term. What's your favorite part about working with founders or companies post-investment?
I think some of it is business development. I would say we're out in the market a lot, right? I think we probably see much more than a founder would see because we just come across more things. Our job is daily to do 10 hours of calls. And so actually going back to the founders and saying, hey, we found these interesting things, or founders coming to us and saying, hey, I'm looking to expand into XYZ space. Do you have someone introduction you can make, a potential partner that you can get? So I think actually helping them build commercial traction in new sectors, new segments, new geographies, that is really exciting to me. Because that, again, I think that goes back to we're adding value to our founders and to our founding teams. So I would say that is one place where I love working with them. The second one is just around, obviously, as I said before, I spent a lot of my years, doing M&A and IPOs and growth stage, late stage fundraising. So working as a thought partner alongside the CEO, the CFO on how should we think about potentially fundraising in the next 12 months? Or how should we think about, non-dilutive sources of capital, right? Should we think of equipment finance as a way to finance this new machinery rather than use equity to fund that? So I think a lot of times that's the kind of value we can add. We back very technical founders often. Our founders are PhDs. They're people who are very, very well versed in building technology. What we can bring to them is a little bit of financial lens based on the experience that we've had in our prior lives.
Love that. That's valuable. Let's look at the future for a second. I'm curious what excites you most about the next 5 to 10 years in these industries: robotics, automation, connected infrastructure, manufacturing, etc.
Yeah, I think what is really exciting, people don't realize this, but there's a lot of robots already at manufacturing, right? If you go to a typical automotive plant and you ask them, hey, how much of welding is automated by a robot? They'll probably say above 80%. How much of painting is automated by a robot? They'll again probably say above 80%. There are some tasks, however, like assembly, which are still very labor heavy, very labor intensive. Wire harness, very labor intensive. And this is not easy work. It is difficult, daunting, dangerous work at times. And I think that is the real potential out here, is what can we do around robotics, around physical AI, around embodied AI, to be able to make these tasks easier, safer, faster, better, more efficient. I think that is the real potential. And I'm really excited because I think we're seeing signs, especially some of our portfolio companies, that these motions are beginning to work. And that brings better safety, better efficiency to our industrial base. And that is really exciting because that's what the economy is built on.
Yeah. Love that. Do you think there's areas where founders should be paying more attention to but aren't yet, like any emerging trends or these technologies that you mentioned?
I think one thing that founders should be paying attention to, I think a lot of times we think about the obvious. I'll give you an example. If you're trying to sell a robotic startup into a warehouse or into manufacturing, the obvious question that everyone has in mind is throughput. How does your throughput compare to someone else, to another robot or to a human or whatever? And I think throughput is the North Star to solve. But actually, if you want, for instance, a humanoid to be in broad adoption at a factory, safety or how it interacts with other people safety protocols, if I'm a plant manager, matter as much as throughput does. Even if you're great throughput, if you don't have the safety protocols in place, I am not going to be putting, when we speak to plant managers, they are hesitant to be putting those kind of robots in play. Autonomous, but that can be a lot of things. It can be autonomous forklifts, it can be autonomous tugs, it can be any of these categories. AMRs, it could be any of these. Like not just throughput, but also safety. And then the other thing is, I think a lot of people think about, oh, my robot needs to be having the same throughput or better throughput than everything on the factory. It's not just about that, it's also about uptime. So like an interesting tidbit we heard from one of the customer calls we did on a robotics company a while ago was actually battery cycling time really matters to me. Like if I have to recharge a battery and the cycling time is I charge for 4 hours, it works for 4 hours, it's not implementable. If I charge for 1 hour, it works for 4 hours, it is implementable, but actually the right solution out here is swapping. So can you have battery swapping? Because no one wants in a 24-hour shift for a robot to be charging for 8 hours and only operating for 16 hours, right? So thinking about that, like not just throughput, but thinking about other variables, I think sometimes we tend to ignore that. And so I think that is something that's like unique and I think hopefully helpful.
Yeah, that is super helpful, I think, for people to think through and like have answers to when asked as well. Let's talk about talent, because obviously close to my heart and something that I'm very focused on. What do you look for in founding teams, especially those tackling complex technical problems, when you guys are investing at this stage?
The kind of, we invest in a lot of, like I would say half our portfolio is hard tech, deep tech, as Peter would call it. And so we're looking for deeply technical founders who have a very keen understanding and insight into developing a great product. Alongside that, we're looking for either that could be a co-founder or it could be a team that knows go-to-market, that has a powerful sales motion on like what does it take actually to sell into these massive customers, which have traditionally been slow adopters of technology. Industrial customers, for a reason why, if you look at the top 10 companies, top 10 startup outcomes, a lot of them end up being consumer outcomes, Facebook, etc., or even software outcomes, right? Because you sell into a much faster sales motion. There's a reason why traditionally, in places like robotics, we don't have a robotic startup that is a $50 billion plus outcome, while we have many software and consumer internet outcomes which are like that. Because our sales cycles, our customer profiles tend to be slightly slow moving as compared to those. So actually having like a robust understanding of like what will it take for me to then bring this amazing technology and sell it into this massive industrial behemoth, that's actually, I think, something that we're also looking for in that. It doesn't have to be in the founder, but it would be nice to have that in that team.
Yeah. I think that's very important. And across like every stage, right? Even from a founding stage early on, to have those expertise, whether it's industry expertise as well as the technical expertise married together, is key. And then just building on that, as you mentioned, for this growth stage. In your view, what does smart hiring look like at the growth stage?
I think it's about hiring for the growth stage, which is you should be trying to make hires which, hey, like I'm hiring a VP of sales, for instance, or a head of customer success. So you're doing maybe 15 million in revenue today. Is this person going to be able to grow into a role to take you to 50 million, to 100 million, right? I think hiring for the future is really important, and not just like hiring for like, oh, this is my need right now, that's what I'm solving for. Think about, can this person be the person who will get you to the next stage of growth? I think that is smart hiring. And some of the best founding teams that we have backed have a very keen insight into backing people who are not just good for how the business looks today, but how the business will look like 2, 3, 5 years down the line.
Yeah. Super important. I'm glad you said that. I think it's hiring for right now is needed and great at an earlier stage, because you're thinking about your dollars, you're thinking about shorter term milestones and all of that stuff. And then I talk about it as like shedding staff. When you get to your Series B, your Series C, the people who have brought you from seed to A are probably not the same people that are going to take you to those next stages, those next levels of funding, the customers, etc. Doesn't mean you have to get rid of them, but you're shedding, you're growing. Maybe you can retain them, maybe not. And some people are just, they're addicted to the startup world and they like that 0 to 1. So for them, it's good as well. Let them go to the next thing, have an honest conversation with them. But, you might have a head of finance, because that head of title is really nice catch-all at the early stage. But then now hey, I really need a heavyweight CFO, or an ops leader or sales leader, CRO, to take us to that next level. And you have to be, to use your wording as well, self-aware as a leader, as a business, of what's needed for now and the future, and make that decision with your eyes wide open. It's crucial. Any advice for founders trying to balance tech, team, and customer development with somewhat limited resources at these stages before they unlock the larger capital?
I think it's a bit nuanced. I think it depends on where you are. I think the founder should always either look towards, hey, what will it take for me to, especially if you're like, at seed, Series A, Series B, it's not your last round of funding. Because you've gone down the venture route, the idea is that you will raise more funding. If you've chosen that, I think what is really important is being able to figure out what would it take to raise the next round of funding. And that can be, hey, it'll be tech, in which case focus on tech. It'll be those, I need to hit certain technical milestones, then focus on that. But if it's like, hey, I need to get certain commercial traction to be able to go raise my next round, like it's not enough for me to come up with a product or a prototype or just have NRE or POC revenue. I need to start showing actual recurring customer contracts, then focus on customer development. But it's just, I think it's you being nimble and understanding what will it take. And I think leverage your board and your investors for that, because that's what they spend their day and night on. Like they understand what it takes to raise a Series A, what it takes to raise a Series B, what it takes to raise a seed, etc., or Series C, Series D. Leverage them because they are the ones who are spending their days and nights in the space. I think the hardest thing in the space is a lot of times, the good news comes very quickly and the bad news doesn't. And sometimes just, I think, having founders, be willing to share what they do not know. What are the unknown unknowns? Share those around the table, because someone around the table might have an answer for you.
Yeah, that makes sense. Thank you for that. That's really helpful. Before we wrap, I know I'm conscious of the time. Couple of quick questions, bonus round if you like. I'm curious about your most surprising or unexpected lesson that you've learned in venture.
I think my most surprising lesson is that actually the companies, everyone talks about, like the companies that are not growing or have high burn, like that's what's going to keep you, worried and concerned. And that's actually, I don't think that is the case. I think actually it's the cases where people are not candidly talking about what is going right and what is going wrong. If I know burn is high, if I know growth is slowing down, we can sit down with the management team and with the founder and figure out what do we need to change, what do we need to fix. We can be helpful. But sometimes I feel like when things are not going well, founders sometimes don't want to share information, and I understand why that happens. But I think that's sometimes by the time we learn things, it's a little too late to be able to change course. So I think that's actually been, my most, surprising thing that I've learned over the years.
Interesting. And what's one tool or app or habit that keeps you sharp in your day-to-day?
I have managed to come up with something which I hopefully has made me a better responder of emails and to do my to-do list. So what I do is I have a note taker join every call. It sends me a summary of next steps, but then I link all that through Zapier into Notion. So I get like a weekly summary of all my to-dos, which is actually really good because then I can keep track of like for this week, was I able to do that or not? Now, the problem is that list is massive. It's like 60 bullets. But I think it's made me better on like being able to do all the small to-dos that come up over the course of the day. The other tool which I really love, which is my friend JJ who introduced me to it. It's called Quarter. It's an app, and it basically has all the financial information that you need in a company. So today, if we talk about Symbotic, for instance, or Fanuc or any of these, and we're like, hey, like, what is a good valuation multiple in the public markets for a robotics company? I could open it up and tell you immediately right now on what those multiples are. And as growth stage investors, we're thinking about multiples all the time when we're evaluating deals. Actually being able to pull that up on your phone is actually pretty powerful.
That's really cool. Which note taker do you use?
Oh, we just use Affinity's like whatever default note taker. It just then I just built it. So I've just linked it to Zapier so that it then links into Notion.
That's very cool. Very cool. Well, look, thank you so much for your time, all of your insights, all your advice. This has been super, super interesting, super impactful, I'm sure, for people listening, and just fun. In all honesty, it's been great having a chat with you. Where can people learn more about you, Woven Capital, and follow along for everything you guys are doing?
Yeah, we have a website, woven.vc. We are constantly putting out insights, thought pieces, perspectives on it. Follow us there. I'm on LinkedIn. And yeah, if you are a founder who's building in or around industrial tech, do give us reach out. We'd love to hear from you. We're here to try and back founders. We're trying to revitalize the industrial base, and we're committed to supporting them through the journey.
Awesome. Well, I'll put those links in the show notes, and let's keep in touch.
Awesome.
Thanks again.
No, Craig, thanks for organizing this. It was great chatting with you today, and appreciate you making time.
My pleasure. Speak soon.
Thank you.